one last thing I'm going to try real quick.
All right, we've got everyone here coming on in. We're going to give everyone just another about 30 seconds or so to log in. We had about 37 people registered.
That's hooray, I fixed it. Nina got it. Oh, thank goodness.
Always technical issues.
Yeah, I was not about to let that go.
Okay. Think you're good? You guys are good?
I think we're good. And I've got the chat up now. So all of that is now moved.
All right, perfect. That's why we do our testing, right?
Absolutely.
All right, well, welcome everyone. Thank you for being here. Hump day, end of the last day of the second quarter. So let's make it a good first half of the year, right? End it on a high note. My name is Jesus Azanza. I'm the chapter executive director for the CAI Greater Houston chapter. We have a great presentation for you today on banking on liabilities, helping managers understand and plan for money owed. So two great companies presenting here today, both premium partners and big supporters of the chapter. So we appreciate the support. Real quick, couple housekeeping items before I hand it over to the chair. This presentation has been recorded. It is pending 1 CE credit. So after the presentation, we will submit it to CAMICB for approval, and 99% of the time it's approved. So keep an eye out for that. We'll email you a copy of the certificate afterwards. Use the chat feature to submit your questions throughout the presentation. We're going to try to let the presenters get through it, but if we can chime in when we need to, we will. And then we are going to have an open mic Q&A question at the end. So with that being said, I'm going to hand it over to Jonathan Clark, who was a past president of the chapter. His firm is a bronze level premium partner of our organization, and he's the current education committee chair for our chapter. So Jonathan, thank you.
Thank you, Jesus. Good morning, everybody. I'm Jonathan Clark, and I am the education committee chair for the chapter. We are continuing with our robust agenda of educational seminars today with a great seminar brought to us by Cox CPA Services and Capital One. We will have a couple more virtual seminars, and in the fall, we're going to have an in-person legal seminar as well. So be looking for that. I have the pleasure now to introduce our speakers. With Cox CPA Services is Teresa Cox and Nina Hammock. Teresa is the founder of Cox CPA Services. She has been practicing public accounting for over 30 years. She graduated from Indiana University and enjoys living in Houston with her husband, Joel, and her dogs, Lucas, Rio, and Hannah. Teresa was previously the audit partner for a local firm, Anakin and Mosier in the Cincinnati area, where she developed her homeowners association niche by auditing community associations for 17 years. And she continues with that practice here in Houston. Nina Hammock has been working with Cox CPA full-time since 2012. She's a graduate of the University of Georgia and is currently studying to get her CPA license. She has been involved with various committees for the local chapter of CIA during her tenure, and she's been very helpful for the organization. With Capital One, we have Kyle Lewis and Keith Francis. Kyle Lewis is a senior business banker with Capital One and has been with the company for 15 years. Keith Francis has worked with Capital One for 19 years and has over 25 years of experience in the financial services industry. As a senior business banker, has enjoyed building relationships and providing trusted advice to clients for the past 10 years. Keith has a passion for teaching and management and enjoys assisting his business clients achieve their financial goals. Both Kyle and Keith joined CAI in 2020. So we clearly have a very talented and qualified panel to bring this topic to us, and we look forward to the presentation. Thank you.
All right, well, we're going to get started. Hello, like you said, this is Teresa Cox and I'm Nina Hammock, and today we're going to be talking about some liabilities. First off, I'd like to give just a fair warning. Our IT guy is currently out of state, so we are doing this on our own, so apologize for any growing pains that you may see. Another thing is if those of you who have seen our webinars before know that we are not above bribery to get you to pay attention. So we are going to be asking various questions throughout the presentation. And what I'd like you to do is send a private message to Teresa Cox, who is audio only on Zoom right now. And the first person who gets the answer correct will get a prize. So in order to, so now let us get started. What is a liability? First person to answer correctly. And I've got chat over on the side, which is why I keep looking to, to the side. So
Because we are tech challenged today. So we'll give you 10, 15, 20 seconds to answer the question, what is liability? And the first person with the correct answer will get a $25 gift card to Starbucks.
So or Kyle said something that loses money or value. That's a good guess, but is not actually what a liability is. Does anybody else have any guesses? An obligation from Kelly Knight. That's a good answer as well. It's, in fact, I think that's probably close enough to count for our purposes. So a liability is anything that the association owes to another party. So Kelly will write your name down and we will get you that prize in once the webinar is over. And now I'm going to turn it over to Teresa to provide a little bit more detail.
All right. So we can say the words and read the definition of what liability is, but what does that mean to us in our daily lives? So what we're going to talk about today is some different kinds of liabilities. So there's two types. The first type is short-term. So some examples of short-term are accounts payable. So this should be the most familiar thing for you guys. So accounts payable is just a normal everyday deal where you get a vendor or an invoice in from a vendor. So let's just say your CPA sends you an invoice for the audit that they did. And you have to get that entered into your software and pay that vendor. So that is accounts payable. Simple, you guys deal with that every day. Prepaid assessments is when an owner pays their assessment ahead of time. So you guys are probably pretty familiar with this too. So let's just say today an owner pays their assessment for September. So they're paying their assessment ahead of time. So that's an example of prepaid assessments. And then the next example is unearned assessments. And this normally just happens in single families. So usually single families bill the annual assessment in January and they only, make the one payment. So we don't want to recognize that entire assessment in January because it's good for the 12 months. So the unearned part in January would be 11 months of that assessment because you've only really earned 1 month. And then the next example of a short-term liability is refundable deposits from homeowners. So what that is if you've got some associations make you pay money in, if you've got a big project going on, in case something goes horribly wrong and something major needs to be fixed and they already have the money in-house to fix it. So like if there's just new construction, some associations might make the builder pay them like $5,000 until the construction's done and then they get their $5,000 back. All right, so then the other type of liability is long-term liability. So we just talked about short-term. The other type is long-term. And that is normally notes payable or debt or lines of credit. So we'll talk about that a little bit later. All right, so now I gave you some examples of the short-term and long-term liabilities, and we're going to spend some time on refundable deposits from homeowners. So these can be known as many, many different things. So refundable deposits, security deposits, those kinds of phrases are used to describe these kinds of things. And they can be for many kinds of things. So they can be for all those things on the left-hand side in that blue teal square over there. Building would be for new construction, usually landscaping, pool, clubhouse would be, for the renting of the clubhouses. In 2020, pretty much that wasn't done, but hopefully you'll start to see that again here in 2021 as the pandemic it comes to an end. So what we've done here is on the right-hand side, we've got some snapshots or screenshots of some balance sheets to show you what these refundable deposits could be called on different balance sheets, because different people call them different things. So we want you guys to be able to recognize the fact that you have refundable deposits, no matter what the phrase is on the balance sheet. So on this one, we have various phrases. We have deposits held. We have pool. Oh, we have rent deposit. I have old eyes. What can I say? And the architectural review. So these are just different phrases. You can see that they all mean the same thing. It's just whatever the person has decided to call them. Okay, so then we have another balance sheet with different phrase. On this one, it's construction deposit. So that's the same thing, the same deal, where the association of vacant people pay money in for a bid project, and then they have to pay it back when they're done. And then we have a third one for refundable deposits. And on this one, you can see where the word refundable deposits just repeats, and then they have a dash and for the different kinds, which pretty much matches all of our examples in the blue square to the left. So those were 3 examples of balance sheets where we wanted you to be able to just look at the balance sheet and just, first of all, just recognize that you do have refundable deposits or security deposits. Okay, so now I want to talk about why are we covering this? Why do we even care? What's the deal? So the reason that we care so much is that these deposits are not the association's money. It's just money that either the builder or the owner is putting up and given to the association until their project is done. And then the association has to give it back if nothing bad happened. So cash is king, remember that? So we always want to track cash. So that's why we care, is because we have to give this money back at some point because it's not the association's money. So tracking the refundable deposits. And we wanted to talk about this because this is the biggest thing that we need in our audits, to have support for all this money that we have to give back to the owners or builder at some point in time. So some softwares will track this within the software. And so we wanted to give you a couple screenshots of the different ones that we've seen coming out of different softwares. So what's important to know about this are all the things that are on this list. So you've got in the far left column, you've got unit number, or that would normally be like a lot number because it's usually single family, but lot number or the address, something that's specific to that particular project. And then if you go kind of towards the middle of the schedule, you'll see this one lists the kind of project it is. So you can see it's a whole mishmash of the different kinds of things we talked about before, where it could be new construction, or it could be a big landscaping job, that kind of thing. And then the next columns are obviously the dollar amounts. So you've got the beginning balance, which for this particular one is December the 1st, because if you look at the header towards the top, you'll see December 1st is the beginning of the date range. So you got December 1, and then you've got money coming in and money going out, which is the activity, and then you have the ending balance. So the important thing to know about this is that it lists the property all by itself, and it says what kind of deposit it is, and it has the ending balance. So now that you have the list, you want to go down to the bottom and look at the total. So that total has to match whatever's on the balance sheet. That's what we do when we audit this stuff. So if we, first of all, we have to have a list, and secondly, if those two don't match, the list and the balance sheet don't match, then we're going to start calling and asking questions. And neither one of us wants to do that. All right. So you can see this is actually one of our real work papers. So you can see the work we've done here, the little green dots. I'm sure must have been that it was all good. And then we've got some changes that we made here that, I don't know, this one must have really been the one with the big cross here, the second one down, must have already been given back and it didn't come off the list or something. But in any case, you can see that we actually do use these lists and do audit work. Okay, so that's just one example of how the list can look. That comes right out of your accounting software. The next one is the same type deal, just out of different software. And it has a little bit more information. It has, which I like, it has some dates on here as far as when the money came in or when the money came out. But you can see for the most part, it's got the address or the unit number, lot number, who it came from. Like I said before, the dates that are coming in and out. And to the far right side, the columns there are the balances. So again, you would want to look at the ending balance down here at the bottom and make sure that that balance actually matches your balance sheet. And a third way is if the software doesn't track, if the accounting software won't track these deposits within the software, then yes, you have to make a spreadsheet. So we have a huge client that this is the case, and they have to track all the stuff on a spreadsheet, and it's a pain, but we got to do it because it's not our money and we have to give it back. So this is an example of a spreadsheet. And again, it's got the same information. We just wanted to show you that spreadsheet is an option. And then on the second page of the spreadsheet, we just wanted to show you that you can, you can put more than what was on the list. You can put there's little notes in here about what's going on and that kind of thing. So before there was 3 examples of balance sheets of how they look, and then there's 3 examples of how the actual list of refundable deposits could look. So now that you have the list, in addition to all that, you should have these little packets for every one of these jobs. So if I'm sure that to start this whole process, you have to fill out a form or an application to for new construction, let's just say. And so on that little packet or that little form, it should say, I'm sure you guys already have this, that should say what the project is and who all's involved. Well, somewhere on there, you should have the fact that they paid the deposit in. So you should note on there, the refundable deposit received on this date for this much, and even have a copy of that check in your little packet. And then when they're done and they want their money back, then I'm sure they give you pictures or something to prove that they're done and they didn't tear up anything. And then you have to give the money back. So then I would have a copy of the check that's written to them, give the money back in that whole packet. So what you end up with is a packet that supports all this information on these lists, because it's going to show you who gave you the money, when it come in, how much it was, when you gave it back, and all that stuff is reflected on that list. So the reason it's important to have the list is because somebody could walk in at any point in time and ask for their money back, and you should be able to just pull up this list and go, okay, here you are, you gave us this much money on this date, so now we owe it back to you. So those are some examples of how you can track these things. All right, so this is not how to do it. So this is what we don't want to see, is just a general ledger. The reasons, because, well, many, but mostly because it only gives you the current year information. So as you guys know, deal with these things, you could start new construction in October of 2020, and even today it might not be done. So you're crossing over a year. So the general ledger is only going to give you the current year activity. Plus, on the general ledger, it's not going to tell you what lot it's for and what kind of job it's for and that kind of thing. It doesn't actually list what makes up the number. Okay, cover all that. All right, so now we know how to recognize these things on the balance sheet. We know how we need to track them. We know how not to track them. And so now we need to talk about a kind of policy that applies to these things. So what we've seen a lot is that we have these associations have these rules about collecting this money, but they don't take one more step in deciding how long are we going to keep this money. So we've had so many instances where, you collect the money, let's just say in this year, and 7 years later, nobody's even asked for the money back yet. So the problem is that money really should still be on the list, because we really do owe it back to the people. So what we're suggesting is maybe the boards consider creating a policy where you only get 2 years, or you only get 3 years to ask for your money back. And then after the fact, then the association does get to keep the money and it can come off the list. All right, so in addition to the kind of policy of how long we're going to keep the money, we can also have a policy as to if we're going to just throw that money into the regular operating cash account, bank account, or if we're going to have a separate bank account to put that money in. And that's what we suggest, because if you have a separate bank account, and the only thing that goes into the bank account is the refundable deposits that you get in. And the only thing that goes out of that bank account is the money that you give back to the people when they're done with the project. Then your liability of refundable deposits should always equal the cash. So it's really easy to check to make sure. And word on the street is that some banks have some things to help you track these things. So I think that Capital One guys would like to talk about some things that can help you with that.
Yep. Good morning, everyone. Thank you again for the opportunity. It's great to be with you this morning. My name is Keith Francis. I'm one of the senior bankers here at Capital One. Nina and Teresa have done a great job of really providing the detailed information regarding operations of the managing of third-party funds. Much coincides with what I want to share with you over the next few minutes, just calling out 3 major pain points that we identify from managers who manage third-party funds, and then 4 questions you and your team may want to consider asking yourselves. Number 1, as it relates to risk and tax reporting, because the processes are so consuming and are manually done, as you saw a few moments ago, due to the requirements for all of the detailed information needing to be documented, right? The regulatory risk could happen. The second, the peace of mind. There's no peace of mind because there's not a streamlined system or platform in place which gives you the ability to open and close accounts, to track funds, segment funds in more of an automated form. This leads to inefficiency and uncertainty. And then the third pain point that we found is that it's a waste of time on administrative tasks. Because there's the inability to control user privileges and permission levels, the manual process of dispersing funds and collecting funds doesn't happen in an orderly manner. The need to request and wait for account activity statements, and the unnecessary trips for you to have to visit the bank just to open and close accounts. With all of that being the case, 4 questions you and your team may want to ask yourselves about the current matters are, number 1, do we have around-the-clock visibility and access to all movement of funds? And that's from first entry to final exit. Number 2, do we have an automated sub-accounting system in place to simplify the tracking and segmenting of all funds? Number 3, do we have the ability to generate real-time individual account summaries, account activity statements? And the last question that you and your organization may want to ask is, do we have the ability to manage the access to funds and control permission levels and privileges to all of our daily operating functions? If you've answered no to any of these questions, you're not currently receiving the full benefits of having an automated sub-accounting system for your daily operations. So definitely consider reaching out to your bank to make sure that you are not missing out on some of those services that they may provide. And of course, you can reach out to me or Kyle here at Capital One.
Hey, thank you so much. Appreciate that. And now it is time for some more low-level bribery. So, question number 2 for today. Who's our co-sponsor? First person to get the right answer will get a $25 Starbucks card. We got Erica Herbert with the right answer. Congrats. Thank you very much for playing. All right, so thank you to Kyle and Keith and Teresa for doing for the security deposit stuff. And now we're going to transition over to the long-term stuff, which is your notes payable and your line of credit. So it can also be known as CIRA Lending or an extension of credit. And it's, usually a loan is, you get a loan when you don't have enough funds to complete the necessary project. Most commonly what we see is this is because of some kind of natural disaster or another, or the age of the property is to the point where things are just all breaking at once. And so you've got plumbing and you've got the roof and you've got the mansard and you've got the, who knows what else. And then the gate goes down and you just don't have enough money to cover it all in one go. So, the alternative to that is special assessments. So the advantage of a loan is it allows for the payment of a large project over a period of time, whereas special assessments, you would have to pay it all in one lump sum, or the homeowners would have to pay it one lump sum. And a loan will keep you from doing that. But the disadvantage is you will have to pay interest. So no matter what the cost is, you have to factor in an additional cost to that just to get the work done. And not only that, but the debt will be on the books for several years, depending on what kind of loan you get. So some things to consider when you are, deciding what to do if a loan is necessary. The first thing to check is, are we certain we don't have enough money in the reserves to cover the cost of the project? That is why you have reserves, literally. So if you think that, if you have a project that needs doing and you have the cash flow, but you want to save that for the rainy day, that's the rainy day. So make sure that that's a consideration. The alternative is a special assessment, like I mentioned before. Do you want to make the homeowners pay a large lump sum, or maybe, for several years in a row, depending on the size of the assessment, all in one go? Another thing to consider is what's more important to avoid. Are your homeowners going to be way more angry because, they have debt on the books and it's, why did we get this loan? We have enough money. Or are they going to be matter about paying a huge lump sum all in one go? Another thing to consider is the collection rate of your association, because banks absolutely look at the accounts receivables when determining loan eligibility. We've seen that many a time where they, have to make a concerted effort to get their collections down before they can even be considered for a loan. And then the other thing to consider is, even if you want to avoid the special assessment, if you don't have the cash flow, you might have to increase your assessments to cover the cost of the loan anyway. So these are, there's no wrong answer. It just, actually there probably are wrong answers, but these are just things to consider when trying to decide what to do when you have a major project and how you're going to pay for it. And now I believe I'm going to turn it back over to Kyle and Keith to go over some more of the nitty gritties should you decide you actually need a loan. And they're going to go into all the details of what you need to know for a loan. All right, guys. You can just tell me when you want to move the slides around and I'll move them.
Okay, sounds good. All right, good morning, everyone. And yeah, I think Nina did a good job explaining that and the determination of when or when you should look for using a loan versus reserves. I mean, ideally, the organization and association would have enough cash flow and reserves in order to get everything done and not necessarily need a loan. But I know how much residents enjoy having increased assessments just so that we can make sure that there's plenty of funds in our reserve accounts, right? So just wanted to go kind of high level over some things to consider when it comes down and you decide, yes, I think the loan is the route we need to go. One thing I'll tell you before we get into this, it will be high level because every bank is going to be a little bit different. And in every lending institution, one of the good things here with CAI is the fact that you have multiple bankers that are part of this group. So just because, let's say it's not something that might fit with what I can look at, we have others. I know I've reached out to Cynthia from times and some other bankers to see if there's some other options. We want to make sure everybody's taken care of. But from a structure standpoint, there's generally two types. You'll look at doing a term loan. Depending on amount, the bank may be able to fund it all up front, one lump sum, and then you begin paying that, making those loan payments immediately to include both principal and interest. The other, if there's a construction component, a lot of times banks will look at doing a non-revolving line of credit. So you'll get a period of time, let's say 6 months up to possibly 2 years, to use that line. And then once that is done, then from that point, it would convert to a term loan over that term that you've discussed and agreed upon. The term of the loan will be how long that loan payment will be made. The next thing you'll see is amortization. That is how long the total amount will be financed over. So if your term is shorter than the amortization period, that will leave you at the end with a lump sum that would be due, or you would have to refinance the loan at that point. Some banks will allow you to have an amortization that exceeds. Some will make you fully amortized, meaning that the term and the amortization need to match. So at the end of that term, it'll be paid in full. So again, those are definitely good conversations to have with your banker. If you go to the next slide. So again, the terms can vary depending on the project that you're looking for. Interest rates, generally interest rates are very competitive in this space, but that'll depend upon how long of that loan term is and several other factors. Fees, those are going to be your closing costs, possible attorney fees, and other things related to getting the loan done. Again, that's going to vary. The length of loan, how long do you actually need that term to be? What are you comfortable paying? And because really what we're going to look at is a couple different things. One, do you have the cash flow to cover it? If not, it would be a special assessment that would need to be put in place over the term of that loan. So how long are you comfortable doing that? Some banks will have a minimum. So it might say if the loan is under $250,000, we're not able to consider it. Other banks might have a much lower, say 50,000 or even lower. Others will have a maximum. So maybe anything over 3 million, we might be able to, anything over 5 million, we may not be able to do. So again, conversations that you should have. Some banks will also require a third-party construction monitoring depending on the scope of the project. If it's a long-term project, heavy into construction, that may be required as well. From a collateral standpoint, generally it's assignment of assessments and special assessments. So the bank would have the right to those if the loan was not paid as agreed, and also lien on all assets using the UCC-1 filing. That's just the Uniform Commercial Code, is what that stands for. It's just a filing with the Secretary of State stating that we have or that the bank has all assets of the association as collateral. All right, and go to the next one. So some of the underwriting standards, so these are things to keep in mind whenever you're going to get a loan. And again, will vary bank to bank. Loan amount versus percentage of aggregate unit values. So that's basically taking the total of all the units. How many units do you have? What is the average value of those units? Add them up, and then banks will generally in the percentage of that. What percentage of the units are owner occupied versus rented? So definitely looking for more of the owner occupied versus the rented units. That can vary as well. Number of units. Some places will have a minimum that you'll need. So let's see, 10 units. Some might need 20. It may not matter how many you have. So it just depends on what their guidelines are. Percentage of delinquent assessments. So making sure that assessments are being paid on time. That just gives the bank comfort knowing that if they did have to use the assessments and kind of go after that collateral, that those are being paid as agreed as well. And then what I kind of mentioned earlier is how is the loan going to be paid? Is it do you have reserves in cash flow that can cover that? Or are you going to need to assign a new special assessment over that term? And what are the board members as well as the residents comfortable with doing? And the other note that audited or reviewed financials may be required depending on the amount and the scope of the project. And that's where you can get with someone like Cox CPA if you need assistance with that. Next slide. So this is a list of some of the things that may be required or asked for to review. I won't go through this whole list because there's quite a bit here. It's fairly exhaustive, so may or may not be asked of you. The one thing I will kind of highlight here, reserve studies. I know that CAI has had webinars in the past that kind of went through reserve studies and the importance of those. And that's something that as you're planning and deciding on whether or not you need to get a loan, having that reserve study of knowing when things need to be done, how much that's going to cost, and basically you can plan in advance. And if you're unable to meet those reserves, that's when you can come to us and see what we can do to help you out from a lending standpoint. Next page. This is just additional information, engineer study on common elements resulting from the capital reserve plan. What is it that what is the full scope of the job? We will need a contractor's bid as we're going through, sales history, and then offering plan, including bylaws. So again, just more information that may be asked from your banker to collect. So, so just wanted to provide, again, some high-level information. If you want specifics, again, recommend reaching out to your banker. You can give me a call, get in touch with Keith, and we'll be happy to kind of walk through those options with you, just so you know exactly what you'll need to get done. And with that, I'll turn it back to Nina.
Awesome. Thank you so much, Kyle. That was fantastic. I'm so glad that you were here to go over that stuff in detail so I didn't have to, because you know way more about it than I do. All right.
I was happy to.
I've got, before I move on to the next slide, I've got one final question, and that is, what is Teresa's favorite color? I'll give you a hint. It's not teal. We got purple, purple, purple. Melissa Bessie wins the race. Good job, everybody. Thanks for playing. All right, so now we're just going to kind of touch on some common misconceptions about HOA liabilities. And the first one is insurance payable. And what so part of the issue is the rules changed probably about 10 years ago. And so the old way was if you financed your insurance policy, so you did the down payment and then the 9 subsequent monthly payment thing. The old way was you actually had to record the amount that you still owed on the policy, and then you offset it with the prepaid insurance. Now, CIRA decided about a decade, or sorry, not the FASB. Yeah, that's the right word. FASB decided about 10 years ago that those rules don't necessarily apply to HOAs anymore, because the policy, is spent over a period of 12 months. So you only need to be responsible for the amount that you've actually paid. So you really will only have prepaid insurance, and you will not have insurance payable anymore. And then another misconception is the insurance claim payable. So this is another one where the rules have changed over the years, and we see this is pretty common where you've either made the repairs from the insurance claim and you haven't gotten the money yet. You'll also see the other way around where you've gotten the money but you haven't made the repairs yet. Both of those are no longer supposed to be on the balance sheet. The rules state that they need to be recorded or recognized in the year that they're incurred. So if you made those huge repairs in 2019, but you didn't get the money until 2020, you're going to have a huge loss in 2019, and you're going to have a huge amount of revenue in 2020. That's just the way it's done now. So if you see, if you have a payable or a receivable for insurance claim on the books and you were auditing it, you're going to see that go away. And then some other fun facts about the liabilities. We just kind of wanted to briefly touch base. And one is the PPP loan. We've been getting a lot of questions about that. The official guidance says that it should be recorded as a liability until it's officially declared forgiven, and then it can be moved to grant revenue on the income statement. So if it was, a grant, or if it was not forgiven until, May of this year, then it's going to be a liability until that time. And then the other thing that we wanted to touch base on was accrued payroll or accrued payroll taxes. And these are more for your condos or your larger single families where you actually have on-site people. Basically, long story short, you calculate that by taking the number of days in the pay period. So if it's, every 2 weeks, and say it goes from like December 28th through January, whatever, you would take credit for those 3 days of December and put that as an accrual. And basically, we just kind of want you to be aware of this existing if you have payroll in your association, and that it should be changing every month because your payroll is not going to be, you're not going to be paying people the same amount on the same day every single month, especially if you're paying biweekly. And now I actually think I'm going to turn it over for question and answer time. Does anybody have any questions? Trees back over here as well. And it can be for any of us.
I'll ask a question. Usually for single families, I assume lending can be avoided with good budgeting in most instances. If you actually fully fund your reserves, it really shouldn't be properly insure your asset, insure common area, fund the reserves. There really shouldn't be much need for lending in the single family space.
Yeah, I would say it's probably rare to get a loan in a single family, right?
I mean, are you asking if you file your reserve study, you shouldn't have to take a loan? Is that what the question was?
Pretty much. Follow your
Yeah.
reserve study and actually carry proper property insurance.
Right, so if the reserve study is accurate and things break when they forecast that they're gonna break or need replacing when it's forecasted, then yeah, if you follow, yes. The whole point is to follow the reserve study, put the money back as it's, because it tells you every year how much to put back and how much you should end up having, how much you're gonna spend and all that. So yeah, if you follow a reserve study and you replace things when it says to replace things, then yeah, you should have enough money.
And the only thing I can add kind of in the single family kind of homeowners association that we have seen is when, let's say, a community wants to add a new like community center or something like that they may not have had funds saved up for. We've done some of those in the past as well.
Yeah.
Ooh, we have a really good question in the chat that I think will be best for Kyle and Keith, and it's describing the impact of unpaid assessments on qualifying for a loan. It's a really good question.
So I would say that it really depends the extent to which. So if you have, let's say, a couple tenants, or a couple residents that are behind, then it's not as big of a deal. If it's a large percentage that are, it can definitely impact the ability to be able to do the loan. So yeah, the delinquent assessments are something that is definitely taken into consideration. One thing I will add, just because it's something that I've seen, and I know we're talking about accounting and proper accounting as well for these liabilities. I had one situation I came across where they did a special assessment for a loan, but the funds, some people had paid up front, so they paid, I guess you could say prepaid assessments, right? And those funds were used for general expenses and not applied to the loan. So at the end of the term of the loan, they were coming up. At the end of the assessment that had all been collected, there was still a large loan balance. So they were then trying to refinance that loan. So again, make sure if there's it kind of back to the point of keeping separate accounting or however you need to do that. Just ensure that whenever those special assessments are put in place for that loan, that any payments made are applied to that loan. Just something that I've come across in the past as well.
Yes, definitely 100% agree.
And Melissa qualified the question with, is it more of a percentage of owners that are delinquent or a total amount outstanding?
So I can say we specifically, or I specifically look at the percentage, but again, that could vary depending. Now, if it's not, if you don't have a large number of tenants, then, and it's a couple people, I mean, that makes a huge difference. But if it's residents, if you have a larger number, then it's not as big, but it's percentage is what we look at, but others might look at total amount.
Awesome. All right, are there any other questions?
I guess it's like a follow-up on that. Where's the line that it's like, hey, let's say you have a 2,300 unit single family, you need access to the lending markets. What percentage of units would have to be delinquent before the underwriters would just say no?
So again, there's not really a specific to go, okay, if it's more than this, we're going to decline it. So we're generally looking for less than, let's say less than 10%, less than 5% of the total. But again, if that's the only thing that's been a little bit of a challenge and everything else is strong, again, it's something we can consider. Those are just, there's not like a, if it doesn't, it's automatically move forward, but just something to keep in mind.
Awesome. Are there any other questions?
Last chance.
I've got the Jeopardy
But-
theme song going on in my head as soon as it's done.
And I don't know who asked that last question, but I will say, if you want to get kind of more into the details and you have a specific one that you have questions on, I'd be happy to take it kind of offline and go through that with you with more specifics.
Thanks, Kyle. Thankfully, my association's well-funded, so probably no lending, but curious if we needed liquidity. I have a feeling we wouldn't be able to get into the lending market, so.
Oh, gotcha. Yeah, and even if it's not something for now you just want to discuss, happy to do that. But thank you.
Well, if nobody has any questions, I'd like to thank Kyle and Keith for going into this with us. And we hope that it was informative and y'all learned a lot. And we will see you all next time. Thank you so much for joining us.
Thank you, everyone. And we will be sure to get a copy of this presentation out to everyone along with the CE certificate, and keep an eye out for upcoming events and emails. Thank you. Bye-bye.
Thanks.
Bye, everyone. For those who won, we'll be getting in contact with you soon. It's not a touch screen.